Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. My first blip looks at what I've been describing as the most important chart. It's the weekly chart for the Dow Industrial Average, which broke below its 200-week simple moving average at 11,672 Thursday morning, opening the floodgates for a new 52-week low at 11,453. While there is daily support today at 11,389, the downside risk is to my annual support at 10,747 in the second half of the year as the second half economic recovery evaporates. I have been asked about where I saw lower support, and for that answer I show the monthly chart for the Dow. At the October 2002 and March 2003 lows, the Dow held its 120-month moving average, now at 10,546. I was pounding the table bullish in the second half of 2002 and in 2003, but with this average now at 10,546 and with recession looming, I don't know what to say at this time. Looking back, the Dow is well above its 120-month simple moving average at the 1987 stock market crash. My second blip reiterates that the bear market is a global event. For this, I've been following the iShares China 25 Fund, FXI, and its weekly chart clearly shows a negative profile, declining 12 by 3 weekly slow stochastic and below the 5-week modified moving average. My third blip reiterates that crude oil is a speculative bubble ready to pop. The Federal Reserve missed the opportunity to raise rates on Wednesday, which only fueled additional crude oil speculation. NYMEX crude oil set a new all-time high this morning, above my weekly resistance at 141.61. The hype of a Wall Street report that gasoline will cost $7 a gallon within 2 years is just plain bad research. Please listen to Senator Joe Lieberman. Raise margin requirements to 25% from 5% and watch crude oil drop to $75 per barrel. A rate rise to 3% by the Federal Reserve would have helped as well. The daily chart for the ultra-short oil and gas iShares DUG shows a bottoming pattern, which remains my divergence favoring the popping of an oil bubble. My fourth blip shows new lows for the housing sector index and the regional banking index. How many times have you heard an analyst tout home builders and how they will rebound in the second half of 2008? That's clearly not showing up on the weekly chart for HGX. HGX set a new multi-year low on Thursday of 110.29. The housing sector index is now 62.4% below its bubble high set in July 2005. The HGX is down 23.3% year-to-date and is 48% below its 200-week simple moving average. The next major support is the March 2003 low of 99.62. With regard to regional banks, how many times we have heard analysis used in this terms? They threw out the kitchen sink with that write-down, or there's a light at the end of the tunnel. Despite rate cuts by the Federal Reserve from 5.25% in September to 2% on April 30th, every rally in the BKX has provided a selling opportunity. Lower rates do not make bad loans solvent, and community and regional banks keep finding more bad loans. The BKX is down 50.5% from its February 2007 high and down 31.1% year-to-date. The BKX is 41% below its 200-week simple moving average, and the October 1998 low is 54.47. If you have any comments or questions, shoot me an email, gmcreports@aol.com. That's today's 4 in 4. Enjoy your weekend.